Hello, everyone, and welcome to Money Show's virtual event. Next up is a very popular speaker at our events, JC Parets, a CMT and the founder of All Star Charts, who's going to tell us what technical analysis really means. JC has a lot to tell us today in 30 minutes, so we probably are not going to have time for questions, but I know you're going to get a lot out of this presentation. So, JC, thanks for being here today, sir. You have the floor. Please take it away.
Thank you very much, everybody. Thank you for being here. My name is JC Parets. I'm the founder of allstarcharts.com. You may see me on Twitter, YouTube, stock twits at allstarcharts. Ping me, say what's up. If you have any questions, you know where to find me. We don't have a lot of time today, so let's dive right in. First of all, I think it's important before we get into some charts to reiterate, again, what is technical analysis? And what is it not, right? Technical analysis is the study of the behavior of the market and therefore market participants, as opposed to the goods and the services in which a particular market deals with. So we don't necessarily care about why a stock is going up or who the CEO is or what the products they make are. None of that is any of our interest. There are a lot of much smarter people than I am with much more information than I have, inside information in many cases. And I am more interested in what those people are doing than what the company itself is doing. So in other words, our clients are some of the biggest hedge funds and institutions in the world. They have more money than God. They have more money than any of these governments. They have more money to get information than anyone else. I don't know what information they're getting with those contacts and money and all of that stuff. I don't know what information they're getting. What I do know and what I do care about is how they are acting upon that information. What are the decisions that they're making with that information that they're receiving? And that's what we study, right? So we provide research for any investor, a lot of financial advisors, hedge funds, mutual funds, family offices, and individual investors around the world. So really, who is our total addressable market? I mean, who comes to us for help? Anybody who needs to put money on a regular, put some money to work on a regular basis. So that's how I see that. So that's what technical analysis is. That's who I am. You can find me at allstarcharts.com. So before we get into this, anything that we discuss here should not be construed as any sort of solicitation to invest in any funds that we manage. These are not buy and sell recommendations. This is strictly for informational purposes alone. And I encourage you to go to allstarcharts.com/terms and check it all out there. So speaking of technical analysis, people are like, well, there's just a lot of charts. And the reason that we look at a lot of charts is because it just so happens that the best way to visualize the changes in equilibrium between supply and demand just happens to be in chart form. You don't need a chart. You can look at them on Excel spreadsheets and everything like that. But in order to visualize it, charts really help. So we look at a lot of charts. Some of the charts that I'm presenting to you today came directly from our monthly conference call that we had just 2 days ago, less than 2 days ago, really. And so a lot of the things that you're seeing here are fresh, the things that we're talking about with clients, in some cases, individual investors or investment advisors. In other cases, some of the top portfolio managers in the world, right? Everyone's getting the same information. What's one chart that for sure stood out to me is financials, arguably the most important sector in the world, breaking out of a 14-year base. And the way I learned it is the bigger the base, the higher in space. And here we are, financials just now breaking out. So people are like, well, JC, we're in a bubble. The market needs to correct. The Trump, the Fed, the Russia, China, this guy, that. 14-year base, new all-time highs, which is confirming what we're seeing in some of the other financial groups. Broker-dealers, new all-time highs. Regional banks, new all-time highs. Insurance stocks, new all-time highs. Capital markets, which aren't shown here, also new all-time highs, all within the financial sort of ecosystem. And now the big guy, XLF, the main sector, while all the ones at the bottom are industry groups, the main sector, now making new highs. And just to put things in perspective, on a relative basis, financials are still down near those lows from 2009, right? If people are telling me we're in a bubble and this is unsustainable, I'd argue we've barely even gotten started, right? I think we really just are getting going. You look at the S&P 500 going out at new all-time highs. What do we know about new all-time highs? We know it is not a characteristic of a downtrend, new all-time highs. Here's another interesting one. People are like, well, JC, the NASDAQ is crashing. The NASDAQ, I got to tell you something. If March would end today, or if March ended a couple days ago, actually, or today, the NASDAQ 100 would go out at the highest monthly close ever in history. So that's not exactly characteristic of us being in the midst of a market crash. Quite the opposite. S&P 500 breaking out to new highs relative to gold. S&P 500 breaking out to new highs relative to bonds. Again, characteristics of uptrends. Let's talk about credit spreads. JC, what's it going to take for you to get bearish? You know, people now call me a perma bull. Notice how I don't get called a perma bull when stocks are in downtrends, right? I only get called a perma bull when stocks are in uptrends. One of the things that we're looking at are credit spreads, right? Is the bond market confirming what the stock market is doing? Here are new all-time highs for the S&P 500 this week, in case you didn't get the memo. And we are also getting new highs in junk bonds relative to treasury bonds, which is indicative of credit spreads tightening, not blowing out. Let's rewind a year ago when we were incredibly bearish of stocks heading into late January, early February. The S&P 500 was making new highs, and junk bonds were already rolling over relative to treasuries. You were already getting that relative bid in the U.S. Treasury bond market, which is defensive rotation, which is indicative of credit spreads blowing out, which is not indicative of higher stock prices. It is indicative of lower stock prices. Sure enough, we got one of the greatest crashes of all time. It was fantastic. It was one of the best months we've ever had. I think it was like the worst day in the history of the stock market. We were quoted in the Wall Street Journal as having the best day in the history of our firm. So the reason I didn't know anything about a coronavirus, I still don't know much about it. I didn't know about, the economic implications of a virus. I didn't know about any of that stuff. But, and this is how we started this conversation, the institutions with the most amount of money and the most amount of power and the most amount of connections and information, inside or otherwise, were acting upon that information. I didn't know what the information was, right? I guess we know now, but we didn't know at the time. All we did know is that what they were doing with that information was selling stocks. Market breadth was deteriorating. It was quite obvious, not just in the US, but all over the world. You saw it in credit spreads, right? And that's where the institutions play. So what's happening today? These are the types of lines that go up when markets are going down, when stocks are going down, right? Bonds tend to outperform when stocks are going down, right? Consumer staples tend to outperform. Gold tends to outperform. Aussie yen tends to sell off. So you're going to get outperformance in yen over Aussie. Well, they're all making new lows. They've been making new lows for months, as we've been pointing this out. However, 2 weeks ago, staples bottomed on a relative basis. So was that it? And now staples start to outperform, and that's the first heads up that something's wrong? Maybe. Again, 2 weeks doesn't make a trend, but if you're going to tell me, hey, GC, what's the one thing that you're keeping extra close eye on these days, I would argue is probably some recent relative strength in staples and utilities. I think that's interesting, particularly with rising rates, right? As rates have been going up, if rates were going down, that's one thing, because you're going to get a sympathy bid in some of those higher dividend paying stocks, but that's not what's been happening. Rates have been going up. New all-time highs in mid caps, new all-time highs in small caps, right? Take a look at those former highs from February in small caps and micro caps. If we're below that, that would be another big problem for stocks, in my opinion. So look at those February highs. I believe it was February the 9th highs, if my memory serves me. And by the way, if you are interested in these slides, I'm happy to send them to you. Just email info@allstarcharts.com. Email info@allstarcharts.com, and the password is short ESG. Short ESG is the password. I give a lot of presentations around the world in various countries, so if you don't include the password, who knows what Malaysian presentation you're going to get. And why is the password short ESG? Because that's something very good to do. ESG investing is one of the greatest scams that Wall Street ever pulled, trying to convince investors that they can save the world through their portfolio. And some investors actually believe it. So that's great. I think there's a great arbitrage there. Those kind of people who think they can save the world through their portfolio are making donations to the market. And it is our job to take those donations and put it in our pockets. 216 in small caps is a big level, guys. Big level. If we are not above 216 in the IWM, that can be a big problem. That can be a big, big problem. That would not be indicative of a strong market. That would be indicative of a weak market, right? So that's 216 on the IWM is one we're watching. For you Dow theory enthusiasts, Dow Jones Transportation Average, Dow Jones Industrial Average, both making new all-time highs. Here's the industrials about halfway to our target, up near 39,000. Here are the transports up about halfway to our target, near 16,500. Let's talk about Europe. Europe has done nothing for 20 years. People tell me that we're in a bubble. We're in a bubble, JC. This is unsustainable. We're in a bubble, right? I'm looking at one of the most important stock market indexes in the world, a broad measure of European equities, the Euro Stock 600, and we've done nothing for 20 years. So I'm not really sure what bubble people are talking about. We're buyers. We want to be buying this breakout in Europe. Here's VGK. Here's HEDJ, which is Europe priced in local currency. And then here's VGK, I think provides a good risk reward for above 60. We want to be long VGK with a target up near 82. Germany breaking out to new all-time highs. If you're curious about what's going on in Europe, Germany's ripping. Even Deutsche Bank is making new 52-week highs. Our target is still $20. France is breaking out. Spain making new 52-week highs. Italy making new 52-week highs. Greece making new 52-week highs. Strength in these sort of markets are just not indicative of risk aversion. You know, these countries, Greece, Spain, Italy, great wine, fantastic wine. For those of you who don't know me, I'm also a certified sommelier. So I, as my wife likes to say, I like taking tests. Not so much these days, but years ago, I took a lot of wine exams. Needless to say, these countries make great wines. Not exactly known for their quality equities market, on the other hand. So to me, that's indicative of risk appetite. Austria, also good wine, not exactly quality equities, also making new 52-week highs. If you're not drinking Gruner Veltliner from Austria, I encourage you to get involved. Nice little Sunday afternoon salad with a little Gruner. Whew, beautiful. Poland making new highs. Turkey making new highs. Hungary making new highs. Japan making new 30-year highs. Singapore breaking out to new highs. Australia pushing up against new all-time highs. New Zealand pushing up against new all-time highs. And then here are emerging markets, right? Emerging markets ready to finally, reminds me of Europe. Europe's done nothing for 20 years. Emerging markets have done nothing for 12 years. So I think a breakout here can be incredibly constructive. China breaking out of this base, Korea in an uptrend, Taiwan in an uptrend, Indonesia in an uptrend, Mexico making new multi-year highs, Brazil pushing up against new highs, Chile making new highs. And I'll stop right there. And the reason I'm going through these countries is not like, to focus on any one particular country, but really to show how we weigh all of the evidence, right? It's not just Greece. Right? It's not just the S&P 500. This is a global market. People are like, well, what about Biden? What about the Fed? It's like, that there are a lot of other countries and they have their own geopolitical issues and they have their own presidential problems, usually much worse than what's going on in America. So like, stop being so close. Not you people listening in particular, but people who I talk to, like just generally, like, hello, the world does not revolve around what's happening in New York City. Right? It's a nice city. It's great, right? San Francisco, Chicago, Miami, right? Great. It's a whole world out there, right? So Chile is an interesting situation because they are the largest producer of copper in the world, and they're breaking out to new 52-week highs. This is part of the short ESG. People who think they can save the world with their portfolio. They cannot. And kudos to whatever financial advisor convinced them of that. And some of these people, it's great because like in many cases, they don't even care. They're like, I just want to save the world. I don't care about the returns. It's like, whoa, wait, what? So that's great because there are people like that just making donations and we will take their money. So for me, it's the opposite of ESG. The dirtier, the worse it is for pollution, the worse it is for the world, the more we should buy it, right? I think that we're entering, or we already entered the beginning of a commodity super cycle. And it's not about saving the world. It's not about, climate change. It's about making money in the market. That's all that this is. If you're in the market for any other reason, I think you are very confused. SQM is a Chilean chemicals company. We want to be long if we're above 60. So we only want to be long SQM if we're above 60 with a target of 89. And this is interesting because I just want to reiterate the top-down approach that we're incorporating. How did we start this conversation? Looking at the currency market, bond market, interest rates, the global stock market, commodities, right? That's how this conversation started, right? That's the intermarket global macro approach that we start with, and then we work our way down. Okay, we like gross, polluting type of companies. Those are the ones we want to buy. Who pollutes the world the best and takes copper out of the ground? Chile. And what's a good stock in Chile that we want to own? This chemicals company. So that's that top-down approach that I think is very, very helpful. And we're seeing it elsewhere. South Africa, in South Africa, we're seeing breakouts. We're seeing new highs in Russia, et cetera, et cetera. We are not seeing breadth deterioration. Here are the percentage of industry groups in the United States making new highs. And historically, breadth peaks before price, right? So we historically see a deterioration of breadth before ultimately the indexes peak. What are we seeing? We're still seeing breadth expansion. We're seeing the most amount of new highs like ever. We're seeing more industry groups making new highs, not fewer. This is the big one, guys. Value over growth. We've seen it. This is not anything that just started yesterday. This has been going on for some time now. Why is value outperforming growth? As interest rates are going up, money managers are less willing to pay those multiples for growth stocks. Again, this is not my opinion. I don't really care why. I'm more interested in the what. But if you want to understand sort of the mindset from the portfolio managers, that's basically the deal. As interest rates are falling, they're willing to pay much higher multiples for growth stocks, less willing to buy the value stocks. In a rising rate environment, it's the opposite, right? And you're seeing that as interest rates have been going up since last year. Again, not anything new. What's been going on? Value's been outperforming growth. What are the differences between value and growth stocks? Well, in value stocks, what do you have? A ton of financials, a ton of energy, a ton of industrials and materials. What do you have in growth? Consumer discretionary, internet, software, technology. Those are the growth stocks, right? So we have been rotating out of those growth names and into value, and not just us. The market in general has been doing that too, fortunately. We're all in favor of it. To me, it's pointing towards higher interest rates. I think this thesis is valid as long as U.S. 10-year yield is above 1.4%. If we're below 1.4%, we're probably going to have to reevaluate this thesis. Also, if you look at, by the way, let me just show you the same chart. So here we're looking at the value versus growth. Then there's an ETF RWVG, which basically does this trade for you. Notice how it's making new highs. And then look at the US 10-year yield. So a lot of similarities between these three things. And if you want a little bit of a cheat code, if you look at financials versus tech, that's basically the story here. Financials over tech, Europe over the S&P 500. You have twice the industrial exposure in Europe than you do in the United States. You've got more financials. And in some countries like Spain, for example, you got twice the financials exposure. And then you're going to get a similar situation in the value versus the value line index versus the NASDAQ, because in the NASDAQ, by definition, you have zero financials and you have zero energy. So for me, that, these are sort of derivative plays of that whole rotation out of growth and into value. Now, that doesn't necessarily mean that we want to short these things. I think if we're above these September highs in technology, you can't be short, right? You see the same thing in software. If we're above the September highs in software, can't be short. You see the same thing in the IPO index right around 59.5. As long as we're above that, can't be short. So far, they've held support where they need to hold support, which makes sense because if you zoom out and you look at technology bigger picture, this is still an uptrend, right? It's still an uptrend. So look at FTNT, Fortinet. It's a $30 billion software company, bucking the trend, showing relative strength. The risk versus reward is great. This comes from our 2 to 100 club, where we're looking for the next $100 billion companies. And this fits that profile. If we're above 160, we want to be long FTNT with a target up near 250. Look at Dropbox. This is an $11 billion software stock. Also part of the 2 to 100, making new highs. $26 is the level there. If we're above 26, we want to be long with a price target of $40. I like the risk versus reward here a lot. I think it's really interesting. Here's an ETF that really talks about this whole short ESG sort of thing. In my opinion, this ETF is ticker symbol is PAVE, PAVE, and it's 65% industrials, 21% materials. Just a lot of companies that railroads, things that probably bad for pollution, probably bad for climate change, but good for the portfolio. That's how we look at it. And how far can this go? I think this chart's going to really give us a lot of information because this is energy. This is the energy sector, which, by the way, represents like 2% of the S&P 500. So, and 0% of the NASDAQ 100, right? And like 1.5% of the mid-cap 400. Like there's just, investors just don't have. This is where passive investors are getting slaughtered. Passive investors have gotten smoked since Labor Day of last year. Absolutely smoked. And well-deserved, right? Just laziness. And I think it's only going to get worse. And as market participants, it's our job to recognize the vulnerability of passive investors and take advantage of them, right? They say you shouldn't kick someone when they're down. But the truth is, that's actually the best time to kick someone, when they're already down. And in this case, they're already underperforming. They're getting smoked. 2,500, 3,000 basis point differences between some of these growth indexes and some of the value areas like energy, like financials. And if you're a passive investor, chances are you don't have the proper exposure to these areas. So it's essentially a squeeze on positioning. Investors just are not in energy. They're not in financials, but especially energy, especially gross energy. In fact, they delisted the coal ETF in the fourth quarter last year. I mean, can it be any more perfect than that? Like, you can't even buy the coal index, and these coal stocks are doing great. Like, the grosser the energy, the better. And if you're interested in what the energy is going to do, we need to get back above these 2016 lows. And by the way, 2019 lows, right? These lows in XLE, if we get above that, the squeeze is on. The squeeze is on. And if oil is any indication as to what energy stocks are going to do, when oil got to its 2016 lows, it ripped right through that. So if oil is any indication as to what energy stocks are going to do, I think energy continues to be a buy. I like Valvoline, VVV. It's a mid-cap $5 billion refiner. It's also part of our Young Aristocrats scan. Our Young Aristocrats looks for stocks that consistently raise their dividends in our scan for between 5 and 9 consecutive years that we think could be the future aristocrats, which are companies that have raised their dividends 25 straight years. So we're looking for 5 to 9 years of dividend growth, making new highs. Valvoline fits that profile, and it is also in our wheelhouse, right? Value, energy. That's where we want to be. Saudi Arabia making new 52-week highs with oil makes perfect sense to me. And then this is the commodity super cycle we're talking about. Copper has done nothing for 15 years. When I tell people copper can go to 8 or 10, they talk to me like I'm crazy. When I tell them crude oil can go to 150, 200, they think I'm crazy, right? I'm telling you, investors just do not have that exposure to commodities, energy, gross polluting stuff. They just don't have that exposure, which is great, right? That's fantastic, because that likely means that we have a long way to go. We're in the second inning, maybe. So if you're interested in these slides, just email info@allstarcharts.com, and the password is short ESG. We're shorting ESG stocks by not buying those and buying the gross polluting stocks. And then we're also shorting ESG investors who don't have exposure into these commodity areas that we want to have exposure to. So we're shorting the whole philosophy of ESG is a short. And that's why the password is short ESG if you're interested in these slides. When we look at the currency markets, we're comparing the performance of these currencies since the bottom last March on the y-axis, and on the x-axis, the performance since the beginning of November. If you notice, the best performing ones are Aussie yen, pound yen, like some of the most risk-on currencies, the ones that are evident of risk appetite, not risk aversion. And which are the worst ones? The safest ones, the dollar and the yen, right? Those are the worst performing ones, dollar and the yen. So I just think it's really, really interesting that the defensive areas are the ones doing the worst. Japanese yen making new lows, gold pushing down near new lows, US 10-year note, new lows. These are the things that tend to do well when stocks are under pressure, and they are just not, right? They're not at all. I want to show you, these are the worst trades in the world. Gold and bonds, right? This is gold versus stocks making new lows, but we already know that. This is gold versus bonds. So these are the two worst trades in the world. Anyone who decided to buy these things last summer instead of anything else, right? It was a terrible decision. So the question becomes, what truly is the worst possible trade you could have put on since last summer? And the answer is bonds, not gold. Gold's right there, but the answer is bonds, as gold is pushing up against new highs relative to bonds. So I think that's really interesting. As far as interest rates are concerned, it's about time interest rates caught up. The copper gold ratio is already making new highs. Regional banks had already been outperforming the overall market, particularly high dividend paying REITs. And now the US 10-year yield is catching up. As they say, bonds move a little bit, move a little bit, move a little bit, and then move a lot all at once. And I think that's what we just saw over the last month. So 1.4 is that level. If we're above 1.4 on the US 10-year yield, the bet is higher rates, lower bonds, and we want to be investing and buying the things that benefit in a rising rate environment: value stocks, commodities, natural resources, the opposite of ESG. And the 5-year yield, I think, is underrated. People don't look at the 5-year yield. I don't know why. It's a great leading indicator. It's my cheat code when it comes to interest rate analysis. We're above those 2012 lows. I don't see any reason to fight this trend, right? We want to be selling bonds. We want to be buying stocks. We want to be buying value stocks. We want to be fading growth. Another interesting part of this, another interesting angle is the uranium space. CCJ is the big one there. The URA is the uranium ETF, making new highs. I like Camco a lot. I think Camco goes to $26, but it really is the whole group, right? Here's just CCJ individually going to 26. We want to be long if it's above 13. Target of 26, but it really is the whole group. Notice how URA looks pretty much just like it. Look at some of these others. NXE. My understanding is that it's about to get added to an index, NXE. So take a look at that if you're interested. National Atomic Company, KAP. These look like bull flags to me for you technical analysis aficionados. These are bullish patterns historically. But let's not front, right? Let's not front. The uptrend is in equities, right? New highs in the NASDAQ relative to gold, new highs in the NASDAQ relative to bonds. And I want to touch on the volatility index quickly. I don't want to be Mr. VIX guy, right? Who's like, oh, this level, that level. But if we have a sustained move lower in the VIX, and the floor in the volatility index has been 20 for some time, really since a year ago, right? When shit hit the fan. But if we get back down to historical floors in the volatility index and we dribble down to that area, like we did in 2019, like we did in 2016, what does the market environment look like if that's what's taking place? What's happening in an environment where the VIX is dribbling down from 20 to 10 or 20 to 12? I'd argue stocks are doing pretty good. Pretty good. Bitcoin still along if we're above 45,000. I'm thinking that it goes towards 75,000. That's the next stop. As long as we're above 45, I think it's fine. Below 45, that's when the trouble starts, right? 45,000 in Bitcoin is like that 216 level in IWM in the Russell 2000, right? Trouble starts below that. And don't ignore the other coins. This is the altcoin market cap. So this is all the other coins, X Bitcoin, breaking out of a 3-year base. This monster base and breakout reminds me a lot of this monster base and the breakout above here, and Bitcoin more than doubled from there. So just want to reiterate that there is definitely a lot going on here. If you're interested in these slides, again, info@allstarcharts.com. Make sure to use the password short ESG. If you don't include the password, they're not going to send you the right password, short ESG. And I just want to show you one more stock. This is AL. This is a $6 billion industrial stock, AL. We want to be long AL if it's above 50 with a target of 72. We want to be long AL, mid-cap industrial stock if it's above 50. We do not want to be long if it's below 50, only above it with a target of 72. So that's my presentation. Info@allstarcharts.com, password short ESG, and I'll stop sharing now so you can see the screen, so I can say goodbye. And one more time, thank you everyone for being here today. Shout out to MoneyShow for the invite. You guys do a nice job. Great presenters every year. I miss actually attending live. Usually after we do this little powwow shindig thing, then we go out for beers afterwards, and that's always cool. Because that's where I win, right? I can do this all day, right? I got so many charts to show you. This could have been a 10-hour presentation. I'm happy to do it. Where I win is in the drinks afterwards and the conversations I'm having with smart folks like yourself. Great questions, gets my mind going. There's some dumb questions too. That's fine, right? But there's always some good ones. There's always at least a handful of smart folks that I meet at cocktails afterwards, and I look forward to doing in real life in person soon.